Good evening, everyone. Live from Chicago. It's Thursday, April 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us tonight. We're going to talk about the NASDAQ bull market, first quarter earnings, and many, many other topics. Those of you that have watched for a while know that we cover a variety of topics on this program, from world economy, economic scenario, employment scenario, recession possibilities, U.S. policy, the Fed, housing, and then recently we've been talking about our investment methodology so that you guys that are clients understand how we invest on your behalf. And those of you that are not clients might be interested in doing so. That's why we're doing that segment. So if you're new to the program, be sure to subscribe to us on YouTube. Click the little bell so that you get updates whenever we publish a video, because sometimes we're not live, we just publish a video. And we are the second Thursday of every month. We tweet every single day on Facebook and on Twitter and on LinkedIn. You can see us there. A lot of people comment that they enjoy seeing us on those platforms. Mark your calendars for next month, Thursday, May 11, for the next episode of CB3 Live. So you may notice something that I haven't been on the air for 6 weeks, and that's because we have moved from Nashville to Chicago, back to Chicago, interestingly enough, about 550 feet east of the condo where we lived in 2017. And here we are. But in the meantime, I uploaded a video interview that I did with market wizard Tom Basso. You guys may remember him. I interviewed him back in September, and when Tom published his new book, The All-Weather Trader, he called and said, I really enjoyed our interview. I want you to be the first one to interview me. And after reading his book, I said, there is so much here. We need to do this in 2 parts. So the first part is live and actually has more views than one of my regular shows. So how about that for humbling? But here's the link on Amazon if you want to check it out. Kindle's only $11.50. You can get a hardcover or paperback. But I just think you should give it a shot. Even if you're not terribly interested in trading, there's a whole lot of philosophy in there, because so much of what we do is philosophy and not even the technical stuff that I talk about on the show. And I think you'll get a lot out of it. Here it is on our site. Again, it's got 110 views, and that was several days ago. So it's pretty popular. Glad you guys are enjoying that. So Bull or bear market? All right, we're flipping from a bear to a bull. I don't know if that dice is gonna come down in full the next time I meet with you, but that's what I'm seeing. And I'll mention at this point, just in case you haven't noticed, the slides are much, much bigger now, and that's because they're full screen. I have decided to be incognito. I assure you, I am still here. But those of you that have watched the show for years now certainly know what I look like, and I have heard from so many people that you just can't see the slides, especially if you're watching it on a phone. So I'm trying this format for a few months. Give me some feedback. Let me know if you like it, if it works for you. So we have had 2 consecutive quarters of bull market activity in the S&P 500. And so I am calling that I think we are done with the bear market. Now, we have not hit new highs, but we don't have to hit new highs to create a new bull market. So if you look at this chart on the far left-hand side, you'll see in yellow there that big green candle. That was the low of the market in October. Now, it is true that I called a market low in June, and then the market came back and tested the lows in October from June when I had called it, and 5 days in October, it closed lower than what I thought the low was going to be in June. All right, but that's pretty close. And since then, it has been moving up and pretty consistent with that. So I'm liking what I'm seeing here. This again is the NASDAQ. This is a long term. We're going to look at several time frames now. This is from 1945. So right around the time of the ending of World War II. And you can see the overall trend, which is the blue line. And when the market moves above the blue line, it's very much in bullish mode. When it moves below it, it's in bearish mode. When it gets too far above the blue line, the bears eventually realize there's just not enough buyers around to keep it going. And so that's what you can see. If you look at the bottom there, you see 08, 10, 2008, 2009 was that huge sell-off. And of course, there was a sell-off in 2000, 2002 as well. But we are up at the top of that, and so you can see how we peaked out above that in 2022. So early 2022, the high, which is still the high, lifetime high, January 4th, 2022. So about 15 months ago. But the market has come back, it's overshot the blue line, and now I believe it's turning around. You guys know this chart. This is going back even farther into the 20s. So a 100-year chart, we've had 3 secular bear markets. Those are long-term bear markets, and I mean long. 20 years in the case of the first one, about 15 in case of the second one, and there's only been 3 in 100 years that are secular. So we need to be careful on the labeling. Secular means multiple business cycles. Cyclical happens within one business cycle. So in my opinion, we are in the 3rd secular bull market. You can see it there on the right with the big black X. And we have, if past history is any indication, we have another 10 years to go in this. Will there be ups and downs? Well, we certainly know there will be because you have seen that the last 15 months. But I still believe we are on track for another 10 years of solid growth, even though there will be some bumps. Yet another indication is the market came down. You can see the high there, the top of the red line. I just mentioned to you January 4th, 2022 was the peak of the market, and then we just ran out of buyers. Why does a market go down? Because there are more sellers than buyers. In the early days, it usually goes down because there are no buyers, because all the buyers have shown up and there's no one left to buy. And if there are no buyers, then there's nothing but sellers. All right, but we have peeked through that. See the green square over there, and that's just another indication. Again, I'm showing you multiple time frames. I showed you 50 years, actually more like 70 years, and then 100 years. This is just looking at 15 months so that you can see that all these patterns happen in and out and how they affect decisions that we're making. All right, so I said earlier there have only been 3 secular bear markets. You saw them on the chart earlier. What are the average declines? Far right-hand corner, minus 57%, minus 50%, minus 49%. Okay, we've lived through 2 of those. All right, well, maybe some of you were, in the markets in the 70s. I graduated from high school. This is actually my 50th high school reunion year. So I wasn't paying attention to the market in 73, 74, but that was definitely a secular bear market. But in my we'll call it adult lifetime. The two bad ones, and I was trading client money during those times. But we haven't had anything that serious since then. Not the 87, which was the stock market crash, not 2020, 1990, which was the invasion of Kuwait. So we know about how long these are going to last. You can see on the chart, they don't go on forever. The problem is they're so painful that they feel like they're going on forever. And that's why I'm here. One of the many reasons I'm here is to let you know that this is history. You're not going to see this on the news programs because they don't want you to see it, because they know if you see it, you're going to go, oh, okay, so we're just in one of these cycles and we're going to come out of it. And we don't need to watch this. Click and you turn them off. They make money when the eyeballs are on the screen in a panic. All right. And I've been saying that for the 4 years I've been doing this program, 3.5, I guess. Don't let them scare you out of what you have. So what can the market do? Well, if we look on a multiple choice test, answers A through D, and you can fill in what the answers would be, the question is not what will the markets do over the next 12 to 24 months, but what can the markets do over the next 12 to 24 months? And the answer is E, everything and anything. And that's always the answer. Most people are not okay with this because they'd rather hear someone say, this is what the market's going to do. We're sure of it, and you need to prepare accordingly. And most of the time, those are fear mongers in the news saying that. You got to get out of the news. Last time I called it and I was right. You got to get out. You got to get out. And most importantly, you've got to watch this show every day to know just how much to get out. Just don't do it. All right. Now, this is April. So April is historically a good month. November and December are the best 2 months of the year. They alternate as to which is the absolute best, but December often wins. But April is the third best month, and you can see why. We break it down into these three periods. Thank you to Earnings Beats for doing this research for me. 31% the 1st through the 18th, so we're nearing the end of this cycle, but the market's been pretty strong the last few weeks. 19 through 24, down only 8%. So when you get into the summer months, you're going to see bigger than an 8% drop in those middle days of the month, and then it finishes on a strong month. So very bullish. All right, gained ground 52 of the 73 years since 1950. Remember, the first long-term chart I showed you was 1950. More than any other month other than December. So April's annualized return. So if every month were as good as April, 18%, yeah, we'd love to take that. All right, ranks third among all calendar months. So I told you that earlier. It's behind November, December. So we are looking for good news hitting the market. And I have never shown you this chart. And now granted, there's only 20% of the stocks reporting. We're very, very early in the earnings reporting. Now remember, we're reporting here in the second quarter, but we're looking back to the first quarter for earnings reports. But for the 20 stocks that have reported, 100% in every sector have reported above what they forecast the previous quarter. That's a pretty good start. You can't get much better than that. Will it hold up? I guarantee you it will not. What's the average mean? You guys know, if you watch my show, it's about 73% are above. Let's see how it goes. All right, this is a great start. Now, the pundits on Wall Street are saying, okay, we think it's going to be a little bit softer here, first quarter. It's going to be softer in the second quarter. It's going to be way softer in the third quarter. Do not believe this. All right, I show you this because you're going to see this news out there. These are people that are reading gobs and gobs of balance sheets and are certain they know that earnings reports are going to go down, and that's what's going to cause a recession, along with decreases in consumer spending, et cetera, et cetera. All right, I can't trade on that data because it's in the future. I have to trade on what's happening in the market right now. So don't let this scare you when you see it out there, all right? So this is where we are over the 12 years in CG. Many of you, in fact, all of you that are clients have at least one CG account. You may have GI, or SO, but of our three programs, almost everyone, I think literally everyone has a CG account. CG is the blue line, the green line is the S&P 500. So what we have done over this time is marked the the pace of the S&P, and then we've had this really nice outperformance when I sharpened my skills in 2020 with the downturn. But then also you can see how we flattened out here for the last year. And so when you guys call and say, why are we not doing as well as we were? Well, I'm going to get into that later on. But the point of this is that you need to be able to outperform when the market's going higher, and then at least mark time when the market's having a flat time, which you can see even the S&P there in the green line is just kind of going nowhere. And on the benchmark comparison chart, I haven't shown you this one before. We're blue, the S&P's green. We're beating the S&P a lot on the upside, but unfortunately, we're beating it on the downside. I don't mean beating it. We are losing to it. We are going down further. So what is happening right now in our offices is honing over the last year and a half here our risk management strategies. We want to be able to capture these big moves right here that you see in 20 to 2022, and then when the market flattens or goes down, to have stringent risk management in place so that we don't give back as much as we've given back in this last year. Now, I'm going to dig into this in depth. If you haven't watched the program before, stick around. That's the last segment in the show, but it's really important if you want to know why every single day we are working hard to maximize your returns on a risk-adjusted basis. So the employment scenario, the reason we do this the second Thursday, I may change this to the third Thursday just because so much happens in the first part of the month. I'm wondering about that. Again, if you have an opinion, feel free to say something about it. But right now we're doing it on the second Thursday because the first Friday is when the employment data comes out, and we were positive. So there's the March unemployment. Again, when we're in April, we're looking at the data from March. So in a 236,000 new jobs created, which is a positive. All right, it's coming down a little bit kind of to the pre-pandemic average there, but still positive and moving in the right direction. Labor force participation rate also increasing. Remember that V-shaped correction we were talking about in 2020 when we were doing the show back then? It continues to pull out of that, and more of American citizens who want to work, okay, you got to want to work, are participating in the labor force, and that's a good thing. Interestingly, though, the average weekly hours of all employees is drifting downwards, and that's because in some areas, the mega cap stocks, you're seeing layoffs. You're seeing layoffs at Meta, which used to be Facebook. You're seeing layoffs at Amazon. You're seeing layoffs at Microsoft, for sure at Apple, and obviously other smaller companies as well. All right. But this average weekly hours of all employees, that's a little unsettling. But I have to report it to you. That's what's going on. And we want to see that turn back up as we move further into the calendar year. This is a great sign. Full-time employment is increasing. So look at the orange line. Both full-time and part-time employees dropped like a rock in 2020. And then part-time workers dramatically overturned full-time workers as we were coming out of the COVID pandemic. Why? Because employers weren't going to step in and take the risk, and for fear their businesses were going to be shut down. That didn't work out too well, did it? As we look back 2.5 years ago. All right. And then they evened out, and now full-time is once again pulling far ahead of part-time. That is a good sign. It means employers are stepping up, saying we need full-time help. We're willing to pay for full-time help. We're willing to pay benefits for full-time help. And that is really important. It's a good sign. It's just a great sign. And it's just kind of a weird time in the job market because the U.S. unemployment rate has fallen to a 50-year low, but there are waves of layoffs and recession warnings that are continuing to break. It's just weird. But again, as long as we keep seeing those positive numbers in the monthly employment number that I showed you earlier, I'm still really positive on the future. So this is an interesting article. I got this from the Wall Street Journal. So do older workers work harder? Most of us on this line are older than younger. And some bosses think so. This guy in Pennsylvania used to fill roles with high school and college students, and for the last couple decades. But this time, as he's reaching this time of the season, late spring when he's hiring, his top candidate's a man in his 70s. Why? Well, because Mr. Conforti has grown weary of younger employees who arrive late for shifts, call out of work often, and spend more time scrolling social media feeds than chatting with customers. So he tried something different about a year ago, recruiting people who are more likely to carry AARP cards than the latest iPhone. It's a really cool article. If you do a search on it, you can find it out there. But this is encouraging to me for those people who have reached a certain age and are thinking, you know what, I want to keep working, I want to do something, but the marketplace doesn't want someone my age. Well, that's just not true right now. And a lot of this is generational changes between how the baby boomers behave and think about work and the millennials. So you may not agree with that, but that's the way that I see it and this man sees it. So inflation is going to continue to be a topic. I get that. But it is less and less of a serious issue. Why? U.S. inflation eased to 5% in March. Now, 5% inflation, not a good answer. The target from the Fed is 2%. See a little bullseye there? I thought that's kind of cute. 2%. The Fed has a dual mandate. The Federal Reserve has a dual mandate. 2% inflation and maximum employment. Notice that they don't set a target on, 142 million people employed. Maximum employment. So they have some fudge numbers there, but their goal is to have the maximum number of employment. Unemployment rate, right around 3.5%. You're never going to get to 0 or even 1% just because of the complicated nature of the economy. So grocery prices fell in March. So you hear me talk about the consumer price index and the two components, that would be energy and food, that are the most mercuric. Those are the ones that are most volatile. All right. So grocery prices falling for the first monthly decline in 2.5 years. Wow. Now that is awesome. It really is. So, households struggling with soaring costs, eggs. I don't know why eggs are so crazy. If you look out there and look at the price of eggs, I need to spend some time on that. But the food at home index, that's something new that one of the brokerage firms cooked up. Oh, sorry, that slipped right out. Cooked up. All right, fell 0.3%, in February to March, and the annual pace of growth is also slowing. So we are seeing inflation slowing. The Fed, I think, wants to see that, but they're still going to continue to raise rates. They're going to be another 0.25%. We'll get to the Fed section in a little bit, but this is a good direction. We want to see this number dropping, okay? And it's not uniform, all right? Of course, I've been saying this for months now, but you can, and I like to show this chart. Men's pants and shorts, why are those increasing? And airfares and hotels, tax preparation and rents, and then decreases in smartphones. I mean, Apple had to slow its production of the iPhone 14 for this very reason. Gasoline going down, even though crude oil, is at $82 a barrel right now. So it's just interesting the way that this works, but inflation doesn't apply uniformly to goods and services all the way across. It's just the way it works out. And today's data, this chart is literally from this morning, the producer price index. So there are three components to GDP. All right, three components, and that is consumer spending, business spending, and government spending. Well, business spending is important. It's not as important as consumer spending because there are more consumers than there are businesses, but consumers, you'll see later on, are a little reticent right now. They're a little gun shy, but because the producer price index, in other words, the cost for producing goods and services for businesses has been dropping since March of 21. So way ahead of the consumer price index. This is a good sign. This is moving back towards, you can see the 2% there. So you really have a tale of, two inflation economies, one for businesses and the supplies and services that they need. All right. And then consumers, which are, of course, global and the United States number, the CPI, is what we mostly focus on. But this reduction in inflation is a great number. So we're inevitably going to continue to get these calls for a recession. All right. I'm just not concerned about them. I think investors in general are less certain about an impending recession than they have been. So March 2009, which was the low of the market, 676.53 in the S&P 500 on March 9th, 2009. That was the peak of the negative sentiment, and then it dropped from there. April 20th which was a little bit past the low. The low of the market during the pandemic was March 23, 2020, and then it peaked at April. And then we didn't get that high. We got to this concern about inflation November 2022, and it's been on the downturn since then. So that's a positive, all right? Now, if you read, sorry guys, super liberal publications like The Economist, they're going to say why there will be a global recession. Well, I guarantee you the people writing these articles are not traders. They don't follow the markets. They do everything from a textbook, and they are certain there's going to be a global recession. I only scanned this article because I didn't want to bring it to you, because the truth is they're just guessing. All right? There are plenty of data points, and I'll show you this when we get to the Fed section, that will support that there will be, and there's many that will support that there's not going to be. And the true answer is we will know when we get there. As I have said for 30 years of managing client money, my ability to predict, that is my ability to predict a recession or a bear market or a bull market, is not nearly as important as my ability to react. Okay? A cornerback in football is the fastest player on the field, not because he can predict. He's not watching the quarterback in his arm saying, I know where that receiver is going to go and I'm going to go right there. He would be embarrassed at least 60% of the time if he did that. But his ability to react and go after that receiver, and that's what we do as traders, all right? At least the good ones. All right, our ability to react and get on the trend when something happens rather than sitting around and predicting. Just my 2 cents, but that's where it is. So this section, extra special tonight, okay? Politics leads to policy. Policy leads to portfolio impact and personal impact. Okay, there is a difference between politics and policy. All right, remember that in about a minute from now, all right? Big difference. And we can either face that policy in certain areas of the United States is going to change and it's going to make it better for those states, or we can stay mired in where we are, all right? So a couple different, well, actually 3 scenarios here. The Biden administration wants to see inflation low, obviously. The biggest driver of inflation is crude oil, because crude oil is energy, and energy goes to gasoline, and it applies to what we're spending at the pump. If people are spending more at the pump, they're going to feel squeezed, and they're not going to be able to spend money in other areas. So any presidential administration wants to see crude oil low, in other words, the blue line at $75 a barrel in 2024. All right, the baseline prediction is it's going to be about 92. It's at 83 right now. The worst case is $1.22. If that happens, I guarantee you there'll be a Republican in the White House, no matter how badly people hate Donald Trump, because people don't want to get hurt with inflation. All right, so I mentioned just a few seconds ago, policy versus politics. Well, I caught up with Kevin O'Leary, also known as Mr. Wonderful, on Shark Tank. And here is a recent interview that he did on CNBC, and I thought his perspective would be provocative for you.
And here's the one thing that nobody saw coming, and this is the competition of states. I don't put companies here in New York anymore, or in Massachusetts, or in New Jersey, or in California. Those states are uninvestable. The policy here is insane. The taxes are too high. We put them in Fargo, North Dakota, because 40% of the people work elsewhere, including Boston. So I was, a bit of a debate with Elizabeth Warren about this, but I say, look, Senator, we've got to move the companies out of your state because you're not investable anymore. You're punishing people if they're successful. You overtax them. You hit them with a super tax. New Jersey, what a mess. New York, uninvestable.
Wait,
California,
why is New York uninvestable?
Try and do a project in New York. Try and build a data.
Yeah, I'm asking, Don's point, is it beyond the taxes?
Oh, the regulatory environment is punitive. I had a project in upstate New York behind the grid in Niagara Falls for electricity, a global data center we were building. Eventually, it got so bad with the politicians in the local region and the state policy, we moved it to Norway and all the jobs. Wow. Norway has it now. Thousands of jobs coming out of that. I mean, that is That's New York. Uninvestable. Sorry, don't shoot the messenger. Just telling you the way it is.
Yeah,
That's
I think
it.
we hear
Uninvestable.
some pushback from our elected officials in New York
I
on
was
that.
just going to say Kathy Hochul.
Yeah, but
I'll
when
debate them any time of the day you want.
we would love to set that
Particularly
up. I'd watch
AOC.
that.
She's great at killing jobs. She kills jobs by the thousands. You know, another New Jersey problem. Where did Amazon take their jobs? They took them away from her. She threatened to sue them if they created jobs. I mean, this is a reality. This is a reality that the business...
There's a little more to it, but let's not relitigate that.
Well, sorry, just telling the truth.
He's saying what a lot of people are saying, especially what happened with that Amazon thing here in New York. Just real quickly, I don't want to hog the conversation, but what was Elizabeth Warren's response when you said that to her?
Look, I have a lot of respect for her because it's okay to have a debate about politics, but not policy. When you have punitive policy, you're making a mistake. And I want to just put up my hand and say, I don't agree, Senator, with your policy. I respect you as a politician, a very successful one. You know, she's very successful, and that's the state where I grew my kids. I mean, our family grew up in Boston, Massachusetts. We left there to move to Florida like everybody else is because it's such a tough place to, you know, this is a tough message. People really are critical about this, but somebody has to call it out because this is a competition of states now, and we don't put money there anymore. We put it in other places, and jobs are created elsewhere. Over time, this is going to diminish New Jersey, diminish New York, diminish Massachusetts, and California out of business. Out of business. El Morte. No business there. You can't do business there. I don't know what that place is going to turn into. Maybe a tourist zone, but no business. Imagine San Francisco. You can't even walk at night out in the street.
Can we
Sorry.
talk about what's happening, though?
Well, guys, I hope I didn't lose too many viewers doing that, but I can't say it any better than Kevin O'Leary can. He's worth about $500 million, and the other Shark Tank guys and gals, women, very successful. So just be aware of it. That's what's happening in America right now. And all of that plays into where businesses are going to be successful. This is a capitalist country, and moving jobs, moving people is going to affect us. It's one of the economic indicators that I follow. So is it important to have a 4-year college degree? Well, for the first time ever in 2023, most people, in other words, more than 50%, say it's not worth the cost because people often graduate without specific job skills and with a large amount of debt. So it's those two together. It's not just the debt or not having the skills, but if you don't have the skills and you don't have the debt, you don't have the money to go back and get an education that'll actually earn you some money. Look at the spread in 2017 and 2013, much, much difference. So we're following this. We think that this has a significant pattern for where the jobs are going to be in America. Consumer spending, as far as contributing to GDP, if you remember, I've just said a few minutes ago, and I've said, you know, for the last however many years I've spoken to people, only 3 sources create GDP: the consumer, business, and government. When the consumer stops spending, it's a problem. So their contribution to GDP is waning. It's being picked up, not by government, but by business spending. And that's the PPI slide I showed you earlier, where inflation is dropping off there. It becomes more cost efficient to produce widgets wherever you are. And of course, that's why I played the Kevin O'Leary segment, because there are states that really want companies to come there and build. So the consumer is going to come back. But right now, that's part of the reason why we are ebbing. And yet in Manhattan, which is the benchmark for determining are rents strong? Are people willing to put money up? I mean, the average, if you follow this article, if you want to go to Bloomberg and do it, about $4,300 a month, the average rent for a Manhattan apartment. That is not 4 bedrooms, 4 baths, I assure you. So there is still demand there, even, you know, despite what Kevin O'Leary said, people are leaving New York. Well, you didn't hit a high here because they are. So it's this dichotomy in the fabric of society where there is still demand for urban living, and yet those very states are not making it easy for businesses to go in and create jobs. So small business optimism, still positive, waning somewhat, above the numbers from a year ago, from April, but it's been stronger. You know, there are just a lot of geopolitical things going on in the world. You know them. I didn't cover them so much. The war and with Russia and Ukraine, things like that. But consumer sentiment is important. Business optimism is the next most important. So the survey, 230, the March actual number, 236, a little bit stronger. Again, these are forward-looking numbers. I don't trade off of these, but this gives me an idea of what I'm looking for as we move into the summer months. What I do like to see, even though I'm not a big fan of debt, is that the credit card debt is now in line with the pre-COVID trend. So you can see the gray trend line. You can see what things were like 2017, 2018, huge dip in January 2020. The reason that gray bar is so thin is because it was only a 2-month recession. I know that's just crazy. But we haven't drawn the gray bar on the left-hand side because we're not technically out of this negative environment. So, but what it does say is, even though consumers say they're not confident, their spending belies what they really are, which means if you're spending and you're willing to put, debt on a credit card, you must be more optimistic than you're stating you are. It's kind of a conundrum, but it's data that I thought you needed to see because it affects, again, not day-to-day trading decisions, but how I'm expecting or anticipating the country could go over the next 3 to 6 months. So I want to thank one of our viewers, Larry. He's been a longtime viewer. He has introduced me. How I missed this, I don't know, but obviously I know what AI is, okay? Artificial intelligence, but this chat GPT, and I'm reading up on it pretty intensely. This is basically an artificial intelligence tool that people can use for many different treatments. And you can see here time spent. The time decreases when you're using this chat GPT and GPT, pardon me. Average grades increase if you're using it for studying and that sort of thing. So just a little bit of background. I want you guys at least to have an awareness of this. When a guy like Elon Musk comes out and says, we need to start regulating AI or curtail it, and that's a huge statement for the biggest capitalist probably in America, but that's because he's concerned about the technology. But my experience with technology is you cannot put the cat back in the bag, all right? So AI can write a song, but I don't think it can beat the market. Maybe that'll change. Maybe there'll be some machine talking to you someday instead of me behind this microphone. But for years, market data has just been noisier than language. So by language, I mean either music or English, obviously a foreign language, computer code, where artificial intelligence can go in and replace actual human thinking, all right, or supplement it. But market data, because there's so many components to it, is still too noisy for AI to be effective, at least right now. That could change, and I assure you that I am following that trend, okay? So, and I'm going to show you charts in just a little bit here about this noise. So remember that word noise, okay? So AI is looking for actual investable data, but it doesn't really know how to process noise, all right? We're going to get to that noise concept real soon. So the technology that underlies ChatGPT is referenced in the second half of its name, GPT, which stands for Generative Pre-trained Transformer. So transformers are specialized algorithms for finding long-term patterns in sequences of data. So we at CB3 Financial use a program called Toggle, which is completely based on artificial intelligence. We don't use it as our main decision maker, but we do use it as a secondary or tertiary source. So if we're getting ready to buy a stock, then we'll just say, so what happened to this stock at this price over the last 15 years? And it'll come back and say, well, in 2015, this is what happened. In 2012, this is what happened. When they declared a dividend, but then didn't follow up on that, this is what happened. So artificial intelligence is looking at history and trying to make a prediction based on quantitative analysis. All right. So that's what we're following. I think it has interesting implications. The Fed is always in the news. That's probably not going to change. And yes, I caught Jay Powell on this selfie. So proud of himself. On a recent down market day, took a selfie of himself. He caused all of that. Good old Jay. Well, if you just speak straight to us, Jay, and quit being so obtuse, you wouldn't have these red numbers so much behind you. Just get out of the way and let the market make the decisions. All right, Jay, please. So right now we're at a 5%. Look at the step ladder there, okay? Notice in 2017 how we just kind of stepped up there and then we stepped back down in 2020. Look at the just almost straight line in 2022 and 23. That is where the fear comes from, because it looks like a knee-jerk panic reaction from the Fed. And the reason it looks like that is because it was that, in my opinion. They can tell you it was calculated. They knew what they were doing. I think they were shooting from the hip. Now, I have said earlier in this broadcast that the ability to react is way more important than the ability to predict. And I get that, but you need to be able to do it without causing panic. And what happens is that when panic ensues, all right? Don't ever take a photo like that again, Powell. Please don't do that. So what happens as unemployment increases? All right. Is there a recession? Well, yes, straight across the board. Okay. Cumulative increase in the unemployment rate. So as this continues to rise, does it rise more than that? The answer is yes, except for one time in 1980. But realize we are nowhere near these unemployment numbers. Certainly not the 11.2 or 5.3, 4.1. We're just not. I stated earlier in the program, we are at lifetime lows. And yes, that's even lower than when President Trump was in office. So you can credit Biden or you can say it was going to happen anyway. That's up to you, depending on which side of the aisle you're on. But the truth is, we are at lifetime lows in unemployment. And yet still companies are laying off people. It's just a goofy time. So the monetary bull case, the Fed will not allow the whole system to collapse. Now, the reason I'm spending time on this is a little wordy, a little techie, but you guys need to know that it's earnings, which we talked about earlier. Remember the 100% there? Okay. And Fed policy that drives the market. There are other things, certainly negative things like a war or a bomb being dropped or assassination, but it's mostly monetary policy from the Fed and what's going on in the earnings situation. So the monetary bull case is the Fed will not allow the whole system to collapse because they have a printing press. You've heard me talk about that. Helicopter Ben Bernanke used to just drop all this money from a helicopter. All right. And the US dollar is the reserve currency, making it pretty much impervious to collapse. But the monetary bear case is that no government or financial regime lasts forever, and history shows that eventually governments get in too much debt and monetize themselves into extinction. That happened with the Greek Empire, with the Roman Empire, the Spanish Empire, the British Empire, and there are probably some others out there too. We are clearly the most important country financially in the world right now, and we are headed in that direction. We have been headed in that direction, and we have done nothing to stop it. Are we to the point where we are ready to collapse? I do not think so. But both cases, the bull case and the bear case, are compelling. All right? They can both be supported by evidence, and I assure you, I watch this on a weekly basis because even though I'm going to have to react to what the Fed does, if I have a fairly good idea where I think it's going, it does give me an extra step or two or three as your money manager. And that's what I'm trying to do. Okay? Which case is right? We're only going to know in hindsight. This above is a great example of why we have to have, a balanced perspective on whether it could be a bull or whether it could be a bear case. And I'm not speaking about a bull or bear market, of course. I'm speaking about Fed policy. All right. And then we trade accordingly on behalf of our clients. So housing market, for months now, this is monthly data. We're in a pullback. We had those incredible months. Although I will tell you that I know from personal experience on the buy side and the sell side coming from Nashville that there's still really hefty demand in the market for the right properties. All right. It may not be across the board like it was in those years, 2020, 2021, but there is still monster demand and paying above multiple offers, paying above list price. So there is still demand. There's absolutely demand. And in not all just red southern towns, okay, in big cities as well. You saw that rent number from New York. So the survey was for 0.5% drop. The actual was only 0.4. That's data from January. We don't have February's yet. So that's a semi-positive. And the fact that these homes are not being sold at distressed levels is also a really big positive. You can see the distressed sales there have just been going straight down regardless of what else is happening in the economy. That's a sign of a solid real estate market. So I started this segment, I think 4 months ago, and I'm continuing to expand on this as we have clients who have come to me and said, I'm enjoying this. I want to understand more of how you invest for me. So I want to dig into that a little bit more. So I'm showing you the screen again. This is exactly the cumulative benchmark comparison that I showed you earlier, where we just had that tremendous outperformance. Those of you that were in CG remember that 63% year in 2020, and the next year was pretty strong as well. 2022, not so much. All right. And this comparison, which is a little more visual to be able to see, we always want blue to be, above green, always outperforming the benchmark on the upside and then doing less bad on the downside. But unfortunately, we're exceeding the green on the downside too. And that is, as I said earlier, where we are working on our risk management here. It's more complicated because of the market ballistics that are, you can say that, well, markets always go up and down. They do, but they do it differently. Every single time or cycle is different. All right. So what's changed in my methodology since October 2022, that says 2023, that's a typo, forgive me, October 2022, is that I'm no longer willing to risk a target of more than 1% of portfolio equity. So if a portfolio is 100 grand and I'm going to buy ABC stock, I'm not going to risk more than $1,000 in that stock. Now, the number of shares doesn't matter, all right, and the position size in the portfolio doesn't matter, but it needs to be no more than 1%, okay? So at least when we open. Now, obviously, when the market goes higher, then you ratchet the stops up, and we'll talk about that in the next month. So that means we're going to be limited to position sizes of 2, 3, or 4%. Other than ETFs. So we do have some bond ETFs where we have a 15%, but there's, like 1,200 bonds in that ETF that, spread out the risk over many different assets. All right. But any individual stocks, no more than 2, 3, or at the most 4%. All right. And the goal here is that growth may be a little bit slower, but the idea is that the drawdowns will be lessened so that we can still capture those up moves, but not have this downturn where stocks just, pummel us and we wait to come back, and it doesn't happen. So what this looks like on a chart. So this is Elf Beauty. This is one of our really strong positions, and people have asked me, clients have asked me, so do you ever just set a target and just sell it? And the answer is no, but I'm going to show you precisely what we do in the video tonight. So you can see the blue line, and this is the benchmark account. So we have multiple accounts that Alice and I trade. This is the benchmark for CG. We have more accounts in CG, but this is the benchmark. And it's up about $3,000 based on where we bought it. You can see the top of the chart. It's continuing to do well. So what if we had sold it, at the beginning of 2023? That would have been a nice gain of about $600-700. But you can see right now it's at $3,000. You say, well, okay, well then do you just wait till it traces all the way back to that red line because that's where the stop is? Well, actually, no, we don't do that. And so here's how it works. So when we invest a certain stock at 3%, eventually if it's winning, it's going to be 3.25 and then 3.5. We had Viking Therapeutics that went from 3% to almost 5% because it jumped 80% in 3 days because they had a new drug that came out and the FDA approved it, and the market went bonkers. All right. So when that happens, we rebalance back to the target 3% and we shave off profits as it goes up. So we have shaved off right here. You can see $3,568. Again, this is my benchmark account. Real numbers. Your mileage will vary, but if you're in CG, you have something similar to this, all right, percentage-wise. So that when it finally sells, we will have already taken some money off the table. And if it were to trace back to the red line and the stop level there, we will still have had some profits on the table, all right? Another example, this is Rambus Technology, which is semiconductors. We're up about $2,200 in this. Again, we could have taken profits and just set a profit target, but that's just not the strategy. You see the little red line there right under $42. That's the current stop level. But we're not going to risk everything down there. Again, we have shaved off some profits here, about $1,600. This doesn't seem like a whole lot, but remember that CG is holding about 33 stocks, sometimes a little bit less, never more. But at 3%, 33, that's 99% invested, 1% in cash. All right. So that's how we are as the market moves higher in these that are winners, shaving off profits and selling high, and then waiting for the market to pull back. And eventually we will be stopped out. We don't ever guess where the top is, ever. All right. However, you're saying, well, but we're not really having a great year. And that's because we've had quite a few small losers as well, and actually some medium-sized ones, but no more than 1%. All right. And some stocks have taken off and not given me the opportunity to do this kind of profit shaving. All right. And they just pitter around and make a little bit of money, and then they end up, being covered for a small loss. And this is cumulative, what that looks like. But we're continuing to refine this process. And part of this is my working with Tom Basso. All right. So that's the show. That's what we're doing. We're covering a wide variety of topics. If there are more things that you guys want covered, let me know on that. I would strongly recommend that you go to Amazon and get Tom's book, read it. If you're on a Kindle, it's only $12. I mean, even if you get 2 or 3 great ideas out of it on how to psychologically, and this doesn't mean you have to manage money, but if it helps you understand how to dialogue with your money manager, which would be me probably, or someone else, then that's a good thing too. At the very least, watch our interview. It's long. I mean, we had a lot to talk about, but we've had 110 of you, or 115 by now, I guess, or so. Watch it and really appreciate that. Have I missed any questions? I'm looking in the chat, saying hi to people. Hey, Debbie from South Dakota, Deb Billis, South Florida, and Fran. I think Fran's in North Dakota. Wow. I might have more people than ever from North and South Dakota tonight on the show. Keith, glad you guys are here. So there you go, guys. It's next time is Thursday, May 11, and we'll look forward to seeing you for that. If you have any questions, just shoot them into the text now. I'll try to answer them before I go off the air. But my thought for the night, retirement should not be, or pardon me, it should be your second life and not a waiting room for death. That's a little dramatic, I know, but I'm doing what I love to do. Am I retired? I don't have to work. I guess, maybe that's how we define retirement. It's being able to choose your schedule. Okay, so I guess I'm in my second life in that regard. I get to do things that I really like to do, and this is one of them. Talking to you guys is one of them. Investing for you guys is one of them. I'm just never going to go and, play shuffleboard somewhere and just wait for death. It's not going to happen. All right, and I hope you'll find the same thing. So since day one, we've always ended with this, and I'm going to do it right now as well. So we have not been given a spirit of fear, even when the markets are tough, but a spirit of power, love, and a sound mind. That's from 2 Timothy 1:7. I hope you guys got something out of this. It is great to be back in Chicago, back home. 3 of our 6 children live here, and 3 of our 10, count them, 10 grandchildren are living here as well. We are super blessed that our son Chip had his first grandchild during the closing of our condo on March 6th. So come up and see us, guys. We've got a pretty cool place here. I'm really excited for the next 10 to 15 years, and I mean that. Warren Buffett in the news today talking about banks and where he sees the future going there. He's 93, and he's still doing the round of interviews on CNBC and Bloomberg. It's just, what an inspiration. All right, I've talked enough. I don't see any questions in the chat. Guys, I'm here for you. Give me a call. You've got my number on the website. Tell your friends, read the book, watch the interview. God bless you. At CB3 Financial Group, we don't just manage your assets, we become one of them. I'll see you next month. Bye.